Look around you. The roads you drive on, the hospitals that treat you, the technology in your hand, the markets that rise and fall every day. Almost everything in the modern world runs on a promise to pay later. Governments promise to repay bondholders. Corporations promise to repay lenders. Homeowners promise to repay mortgages. Students promise to repay loans. The global economy isn't just influenced by debt. It is built on it. And here's the mystery. If our entire system depends on borrowing from the future, how can it possibly be sustainable? Can an economy permanently expand by pulling demand forward from tomorrow? Or are we living in the most sophisticated financial illusion ever constructed, one that works beautifully until it doesn't? Tonight, we're not just asking whether debt is too high, we're asking something deeper. Is a debt-based economy a brilliant engine of growth, or a slow-motion collapse waiting for the wrong spark? Setting the stage, when money changed its nature. For most of human history, debt existed, but it wasn't the foundation of civilization. Ancient Mesopotamia recorded loans on clay tablets. Medieval merchants borrowed to finance trade expeditions. Kings borrowed to fund wars, but money itself was scarce. It was metal, gold, and silver. To lend money, someone first had to save it. Savings preceded borrowing, then banking evolved. With the rise of fractional reserve banking, something radical occurred. Banks discovered they didn't need to keep 100% of deposits in reserve. Only a fraction was required because not everyone withdrew funds simultaneously. This meant they could lend more than they physically possessed. Money began to be created through lending. And here's the crucial shift. Debt stopped being a transfer of existing money. It became the creation of new money, cause and effect. Loan issued, new deposit created, money supply expands. The system was no longer constrained purely by physical gold, but gold still acted as a governor until it didn't. In 1971, the final link between the US dollar and gold was severed. The global monetary system transitioned fully to fiat currency, money backed by government decree and trust. From that moment on, money creation became policy-driven, and debt-based growth accelerated. The constraints were gone, only confidence remained. Origins, the birth of the modern debt engine. After World War II, the global economy required reconstruction. Governments borrowed heavily. Central banks supported fiscal expansion. The Bretton Woods system anchored currencies to the US dollar, which was pegged to gold. But as decades passed, US spending on wars and social programs expanded faster than gold reserves. The imbalance grew unsustainable. In 1971, President Nixon suspended gold convertibility. The dollar floated, other currencies followed. Fiat money became the global norm. This moment is often misunderstood. It wasn't just a technical monetary change. It fundamentally altered the incentives of governments. Without a gold constraint, borrowing in domestic currency became easier. Deficits were no longer limited by metal reserves. Central banks could create base money electronically to purchase government debt. Debt no longer required prior savings. It required political approval and central bank coordination. Cause and effect again, unconstrained currency, easier borrowing, larger deficits, larger bond markets, greater reliance on debt financing. By the 1980s, sovereign debt markets were central pillars of financial systems. Government bonds became risk-free assets. Banks held them. Pension funds depended on them. Insurance companies relied on them. The foundation of modern finance became sovereign debt. But debt wasn't just a government story. Household credit expanded dramatically. Mortgages became widely accessible. Credit cards proliferated. Corporate borrowing surged. The entire economic structure tilted toward leverage. Growth increasingly depended on credit expansion, and the machine began accelerating. The rise, debt as growth strategy. From the 1980s through the early 2000s, global debt grew faster than global GDP. Interest rates steadily declined. Lower rates made borrowing cheaper. Cheaper borrowing encouraged more debt. More debt supported higher asset prices. Higher asset prices increased collateral values. Increased collateral supported even more borrowing. The feedback loop intensified. Consider housing. When mortgage rates fall, home affordability increases. Higher demand pushes home prices upward. Rising prices increase homeowner equity. Equity can be borrowed against. Spending rises, GDP rises. Politicians celebrate growth, but the growth is debt-fueled. The same logic applied to governments. If interest payments remain manageable, deficits appear sustainable. If GDP grows faster than debt servicing costs, the system appears stable. So policymakers favored expansion. Why endure recession when credit expansion can smooth it? Why tolerate deflation when monetary stimulus can inflate demand? Debt became the shock absorber. Recession, lower rates, more borrowing, recovery. Each downturn resulted in larger interventions. Each intervention left debt at a higher baseline. This is path dependency. The floor kept rising. And because inflation remained relatively subdued for decades, central banks believed they had mastered the cycle. They hadn't. They had postponed it. Breaking point. The illusion cracks. In 2008, the illusion fractured. The housing bubble burst. Mortgage-backed securities collapsed. Banks faced insolvency. The global financial system froze. Here was the moment of truth. Would excessive debt unwind? Would markets purge unsustainable leverage? Instead, governments intervened at unprecedented scale. Trillions in bailouts, massive deficit spending, quantitative easing, central banks purchasing government bonds and other assets with newly created money. The logic was clear. Allow collapse, and the financial system disintegrates. Intervene and stabilize confidence. The choice favored intervention. Debt surged. Central bank balance sheets ballooned. The immediate crisis was contained, but the underlying structure changed. Markets internalized a new expectation. Central banks will intervene to prevent systemic collapse. This belief altered risk behavior. If downside is cushioned, leverage becomes more attractive. Asset prices recovered rapidly. Corporate borrowing accelerated. Government deficits persisted. The system survived. But it emerged more dependent on debt than ever before. The second breaking point. Pandemic shock. In 2020, the world faced a new shock. Economic activity halted almost overnight. Governments imposed lockdowns, businesses closed, unemployment spiked. The response dwarfed 2008. Stimulus packages reached trillions. Direct payments to households, expanded unemployment benefits, corporate rescue programs. Central banks cut interest rates to near zero. They expanded asset purchases. They provided emergency liquidity facilities. Debt levels exploded. Global debt exceeded $300 trillion. For a moment, it seemed miraculous. Markets rebounded. Stock indices reached record highs. Housing boomed, but beneath the surface, something shifted. Inflation returned. After years of muted price pressures, consumer prices began rising sharply. The hidden cost of expansion surfaced. Cause and effect: massive stimulus, money supply expansion, demand surge amid constrained supply, inflation spike. Now central banks faced a dilemma: raise rates to fight inflation and risk destabilizing heavily indebted governments and corporations. Keep rates low and risk entrenched inflation eroding purchasing power. The trade-off revealed the fragility of a debt-based system. The more debt accumulated, the more sensitive the system became to interest rates. Small rate increases meant massive interest cost increases. The margin for error narrowed. Fallout: the silent consequences. A debt-based economy doesn't collapse overnight. It shifts burdens. When central banks expand the money supply, asset prices typically rise first. Stocks climb, real estate appreciates. Financial assets inflate. Those who own assets benefit disproportionately. Meanwhile, wage growth often lags behind asset inflation. Savings lose purchasing power. Middle and lower income households feel pressure. Wealth inequality widens. This is sometimes called the Cantillon effect. New money enters through financial channels, benefiting early recipients before prices adjust broadly. Over time, structural consequences accumulate. Governments allocate increasing portions of budgets to interest payments. Corporate profits depend more on financial engineering than productivity. Households become sensitive to rate fluctuations, and political tensions intensify. Because debt isn't just an economic variable, it's a social one. When younger generations inherit massive public debt burdens, intergenerational friction grows. When housing affordability collapses under asset inflation, social mobility declines. When inflation erodes wages, trust in institutions weakens. The sustainability question becomes psychological, not just mathematical. Sustainability or collapse, so where does this leave us? Is a debt-based economy sustainable? The honest answer is complex. Debt itself is not inherently destructive. Borrowing to invest in productive infrastructure, education, and innovation can enhance long-term growth. Credit allows consumption smoothing. It supports entrepreneurship. It enables development. But sustainability depends on proportion and purpose. When debt finances productive capacity, growth can outpace obligations. When debt finances consumption without productivity gains, burdens accumulate. The modern challenge is that a significant portion of global debt growth has supported asset prices and consumption rather than transformative productivity. That doesn't mean collapse is inevitable. It means fragility increases. Debt amplifies both growth and contraction. It smooths cycles until it magnifies them. The system can persist for decades if managed carefully, but the margin for error shrinks as leverage grows. And history teaches us one consistent lesson. No financial structure expands indefinitely without adjustment. Adjustment can be gradual, through inflation, financial repression, and currency depreciation, or abrupt, through default, restructuring, or crisis. The path depends on policy choices and public trust. 3 clear takeaways. 1. Debt is a tool, but it becomes a trap when overused. Borrowing can stimulate growth, but excessive reliance transforms flexibility into vulnerability. 2. Interest rates are the system's pressure gauge. When debt levels are high, even small rate increases carry outsized consequences. Monetary policy becomes constrained. Confidence is the invisible foundation. As long as people believe debts can be refinanced and currencies retain value, the system holds. Once confidence fractures, adjustment accelerates. Failed fixes. Why reform stalls, calls for reform are not new. Balanced budgets, fiscal discipline, monetary tightening, return to commodity backing. But structural incentives undermine reform. If governments dramatically cut spending, short-term growth slows. Unemployment may rise. Political backlash intensifies. If central banks raise rates aggressively, debt servicing costs surge. Asset markets fall. Recession risk rises. Policymakers face a paradox. Long-term sustainability requires restraint. Short-term stability requires expansion. In democratic systems, short-term stability often wins. Debt ceilings are raised. Stimulus packages pass. Quantitative easing resumes during stress. Reforms are partial and temporary because the system is not designed for contraction. It is designed for expansion, and expansion requires credit. Modern parallels. The repeating pattern. Today, we see familiar patterns. Global debt relative to GDP remains historically high. In many advanced economies, interest payments consume growing shares of government revenue. Corporations roll over debt rather than repay it. Household leverage remains elevated in several housing markets. Emerging markets face currency pressures when U.S. interest rates rise, and central banks navigate a narrow corridor between inflation and financial stability. Each tightening cycle reveals fragility. Each easing cycle reinforces dependency. The cycle resembles a ratchet. Debt rises during crises. It stabilizes briefly, then rises again during the next shock. The baseline never returns to previous levels. Some argue technological innovation and productivity growth can offset debt burdens. Others argue that as long as economies grow faster than interest costs, debt remains sustainable. But that condition depends on continued expansion. If growth slows structurally, due to demographics, productivity stagnation, or geopolitical fragmentation, the equation shifts. Debt sustainability is not static, it is dynamic. It depends on growth rates, interest rates, inflation, political stability, and confidence. Confidence remains the hidden pillar. As long as investors believe governments can refinance obligations, bond markets function. As long as citizens trust currency stability, money circulates. But if belief erodes, adjustment becomes abrupt.